Good evening, good afternoon, good morning, whichever part of the world you may be in. My name is Malik, and I'll be your moderator for this panel today evening, 7 p.m. Singapore time. It's my pleasure to host this panel with four fabulous panelists from not only different parts of the world, but different backgrounds and different perspectives that they will bring to this panel. So without further ado, let me get started with the brief introductions from each of the panelists. We are going to look at an important topic that's going to be more and more center of plate for financial services as we go along, and that is the role of AI, ML, machine learning when it comes to financial services and how it is going to impact this industry. We look at the good, the bad, and the ugly. So we'll not just look at a rosy picture, that much I can promise you. With that, I would love to start the introductions. So Arvind, Avril, Simon, and Greg will go in that order, please.
Thanks, Malik, and it's a pleasure to be here at the virtual FinTech fair and on this esteemed panel. I am currently a senior advisor with the Asian banking practice at McKinsey. In my previous life, I was a retail banker, spent 25 years mostly in Asia Pacific and Europe in the retail bank, consumer banking space. Big proponent of technology, have seen the rise and evolution of the AI through the years. In the previous 5 years, I had the opportunity to be in the venture industry space as a board advisor and investor. So I've had the chance to look at some of the emerging startups as well. Looking forward to our discussion.
Thank you. Avril, you're on mute, please.
Yeah, schoolboy error. Hi, everyone. My name is Avril Ray. Thank you for having me here today. I started my career in technology more than 20 years ago, so I'm giving away my age a bit here. But I've been supporting financial services for the past 15 years with technology. And most recently, I've been working for one of the big four, looking at FinTech and how companies can leverage FinTech to improve their businesses, and also evaluating FinTech companies and looking to help them with fundraising, new market entry. I'm an investor to FinTech companies and an advisor to a local FinTech in Hong Kong. And I'm looking forward to this discussion. Thank you, Malik.
Thank you, likewise. Simon?
Thanks, Malik, and also good to be here, and interesting, with interesting combination of people across the world. My name is Simon Hardie. I'm co-founder of a company called Findexable. I come from a financial services research and intelligence background, but we are building something we call the Global FinTech Index, which is a real-time database and catalogue of FinTech innovation globally. We're using an algorithm to rank and score FinTech ecosystems, and we will be expanding and developing that to rank and profile and ultimately score FinTech companies themselves. So, interested, in the role of AI in terms of how it's playing out globally, and we're starting to track some of that across the index that we're building, but also interested from a business point of view, because our algorithm is an automated tool, and we'll be using more AI and deeper technologies to sort of improve and optimize the solution that we're building over the next couple of years.
Thanks, Simon, and I will be touching upon that aspect briefly in the context of financial services. So look forward to that. Greg, thanks. Over to you, please.
Well, thanks, Malik. It's a pleasure to be at this panel discussion today. My name is Greg Au-Yeung, and I'm originally from Hong Kong, and I've been in the financial industry more specific financial technology industry for about 25 years. And throughout my last 15 years, in particularly, I've been stationed in China and building different foreign banks, technology hubs in the mainland. And my last job is actually with Saxo Bank, which is really a FinTech. And I've been building the capability in China, for them to enter the mainland financial services. So once again, it's a pleasure to be in this panel discussion.
Thanks, Greg. And very quickly about myself, my name is Malik. And in my 1.0 avatar, I was a banker, like many of you here, spent 20 plus years in banking, mostly with Citibank, and mostly in digital banking and payments, e-payments. So I have been lucky to be in fintech even before the word existed, or even before there was a Facebook or Twitter in the digital world. I've been seeing this for quite a while, the ebbs and the flows. And my 2.0 avatar, I wear multiple hats. One of them is I am the co-founder and board chairman for Global Impact FinTech, which is the most diverse and inclusive impact fintech forum we have globally, with members from 40 plus countries. And our friend Mushir is a board director over there as well, one of the founding directors. I am also the co-founder and chairman of Innovation Labs, which is a venture growth company in ASEAN, trying to bridge the gap between banks, fintechs, and regulators. And finally, I am also the adjunct professor for fintech at the Asian Institute of Management, where I have developed and I teach the fintech course to MBA and executive MBA students. So let's get started. And I'm going to target this first question to both Greg and Avril. And let me start with a very personal example. I normally don't do it, but because I think it's important, and I have been grappling with this question quite a bit, of why are we hearing so much about AI in financial services or AI right now? And I'll give a personal example. When I was an engineering student, almost 30 years back, and when I entered the campus, at that point in the early 90s, we were already hearing quite a bit about neural networks. There was a buzz around it even then. And then, in the last 3, 4, 5 years, suddenly we've been hearing about AI in financial services all over the place. There was, as they say, the AI winter for about 20 years, and suddenly we are hearing this buzz. So my question to Greg and Avril is, why now? What are the factors which have changed, or what are the triggers that suddenly we are seeing, if I may say, this renewed interest when it comes to AI, and what are the enablers? Either of you can go first.
I'll go first in case Greg steals some of my answers. So, from my experience at a previous company working for a data provider, it was quite known that the banks were using machine learning for 10 plus years. For example, news analytics, sentiment analysis. So it's not new for the global banks. So, but the main reason is data, and the amount of data that is now available is impossible to be dealt with manually. And I think that is the main reason. The ability to classify, tag, and build relationships and deal with huge quantities of data. And also, I think the maturity of tools has developed to a point where it makes it much easier to implement. So they're my two main reasons.
Okay. I guess my take is that for the last 5 to 10 years, I think we saw the surge of AI in the industry, and for a few reasons. I think the availability of the vast data, as Avril already mentioned, but also the enhanced computer power. I think that is already took off, which give rise to the machine learning, or in particular the AI fintech space in financial services. And also the other thing is the applicability. Meaning, in the investment world and also in the lending world, that there are hard evidence that it contributes to the bottom line, and with real tangible benefits reasonably quickly. And for example, revenue generation side, I think the algo trading, the robot advisors, high frequency trading, all of this actually took off last 10 years. And with this search, and even algo trading, I think it's not new. Using machine, coding and etc. But the AI actually is a catalyst to actually accelerate this the usability, in the machine learning. And then on the risk management side, the fraud detection, AML, KYC, etc. That also contribute to reduction of losses, in the industry. So I think there's a hard evidence that in the industry. And the last piece is actually the number of startups or the fintech that have been piling up and actually emerge, and which they already have tools and software available, which the incumbents can actually use. And that's why I think there's the tendency of a lot of the banks are actually start to use or to partner with them. That is quite evidently, in the last, especially in the last 5 years, with the change of heart.
Thank you. So those were very on-point answers. And if I were to quickly summarize it, basically the 3 V's of data, as we call it: volume, variety, and velocity. the ecosystem, as you mentioned, Greg, the proliferation and mushrooming of all these fintechs, etc., and the ability to put together an economic model when it comes to ROI, etc. So thanks for that, and I think that will be quite useful to our audience trying to make sense of why they are hearing so much about AI, especially in the last 5 years. So now that we've looked at the why, let's look at the what. And this I will address to Arvind, Avril, and Greg. You are free to jump in if you want to. What are the areas in financial services where you see the maximum proliferation of AI, and why? And again, there is no right or a wrong answer here. We've seen it in back office. We are seeing it in middle office. We are obviously seeing a lot of pilots when it comes to customer-facing interactions, etc. But in your view, where and how should a bank start, and why? And Arvind, we can start with you.
Thanks. Yeah, I've spent all my time during my banking career as a business practitioner. I built and ran businesses, owned P&L, and therefore owned the commercial case every time when it came to implementation of new technology. And I'd say that what has happened post GFC is that banks' ROE dramatically dropped to single digit, because of regulatory costs, because of margin compression, because of things like offshoring not providing cost arbitrage anymore. So with that as backdrop, banks were forced to look at certain areas of operations and new technologies to try and help eliminate, automate, reduce, minimize, etc. And therefore, areas that became the focus areas were places that had vast amounts of data. So things like contact centers, which had high volumes, fund transfer in back office, or transaction processing, these all became the immediate candidates for the implementation of AI. And at the same time, there were competitive pressures, particularly in the last 5 years, from BigTech, from the BAT and the FANGs, who frankly, in this round, I think have stolen the lead in terms of where they are in terms of AI leadership. So banks have felt that pressure as well to look at the front end of the house in terms of CX and trying to simplify that. So I think those are the areas, to my mind, where we are seeing a lot of use case deployment. And I can get into some level of depth because I've been personally involved in deploying 3 use cases. One was in credit collections, and I think Greg alluded to that. And the specific use case was to predict whether a delinquent account in an early stage, that is X days, will actually roll to 60 days or not. Because anything beyond that, there's a very high likelihood of charge off. So that was one very specific use case. And the second one was on regulatory compliance, where it was to do with AML suspicious transaction monitoring. As you know, with rule-based systems in AML compliance, the false positive ratios have been extremely high. We're talking about 1 or 2 for every 10,000 of alerts that are generated by rule-based systems. So the deployment of ML in that particular use case has seen some very good results. We've seen 40% reduction in false positive ratios, 5-10% lift in true positives, etc. And the third one is around contact center ops. And when I say contact center, I mean more broadly omni-channel, where there is a very strong use case for hyper-personalization of the campaigns and offers and products and services. Banks have always struggled to be able to present the next best offer in a relevant contextual manner that uses vast amount of big data and ML. And I think I've seen that hyper-personalization use case work pretty well. And we can talk in more detail about it, but I'd love to hear the other thoughts as well.
Thank you, Arvind. Avril, would you like to go?
Sure, yeah. I think Arvind covered some good points there. Obviously, with the back office, there's a lot of automation that can take place. I came across a recent example, which I quite like, where JP Morgan was using contract intelligence to automate legal document processing. So, doing data extraction and reviewing legal documents. And I think, many banks are having to use this type of technique to address regulatory changes and things like LIBOR and, being able to, manage and stay on top of these changes by using those types of techniques. Also credit scoring. You know, if we look at what's happening in China, you know, WeBank have been doing some fantastic things, and the ability for them to onboard and credit score within seconds, you know, it's really impressive. And I think if the traditional banks are not able to improve on how their ability to onboard and to do things like the credit scoring, you know, will mean that they are left behind. I mean, the banks, you know, do have a lot of data about their customers. And so, you know, they can perform credit scoring and learn from their mistakes and move much more faster and provide more accurate results. Fraud, I think Arvind already covered, but, you know, analyzing patterns, client behavior, machine learning to detect abnormalities in card spending, for example. Personalization, hyper-personalization, I like that. I agree with the virtual banks in Hong Kong. We're expecting, you know, great things that the traditional banks have been underserving us in that respect. So, you know, providing a tailored approach, using the data that they know about us to actually, you know, create products and service us better. So that personalized approach, I think, is a must for any bank going forward.
Thank you. Greg, would you like to add to it? Because I have a couple of points that I want to press on further with Arvind and Avril, especially around hyper-personalization as well as this delinquency modeling that Arvind referred to. But if you have something to add, and Simon, please feel free to jump in as well. Then I ask my questions.
Sorry, just one quick point. I think when we talk about the WeBank, for example, as Avril mentioned, I think that is a pretty good case study, I would say. And I think, you know, what you see is that, you know, you actually using not just machine learning, but ABCD basically, right? You know, artificial intelligence as well, big data, etc., to actually tackle the real problem, to tap into an unbanked population in China, which the main banks or the incumbents never really bother because, you know, they are very profitable. But now when the tide is changed with COVID and everything else, I think even a couple of years back, you know, the profit is not as good as before. I think it gives them a new direction for them to actually look into this. Actually, this could be very, very profitable if you use technology to discover new clients, and those are clients could be very, very profitable. And if you're willing to do that, I think this is probably one area that, you know, a lot of the incumbents are looking into now.
Yeah, I'd have one thing to add. You know, I think the challenge with, you know, something, and it's much like talking about the growth of the internet 20 years ago or blockchain a couple of years ago. You know, the technology starts to dictate the business. You know, and ultimately, you know, you've got to think what is it that's good for the customer here. You know, the really great thing about the successful fintechs has been the understanding, their implicit understanding that culturally, you know, they've got staff that are bought into the company because they have the freedom to give them equity or give them ownership. And they also have the freedom to maneuver and adapt and respond to what the customer wants. And quite often that, you know, the talk around the table within successful fintech companies especially is not about the technology, it's about, you know, how does one build a new kind of relationship with a customer. And interestingly, just recently, you know, we've been in the process of doing a research piece on provision of financial services to small business in Europe. And without fail, pretty much all the small businesses that we interviewed said that they want, you know, a personal relationship. They want to talk to somebody at their bank. Now, I'm not sure I believe that. You know, I think what it's actually saying is that if something goes wrong, they want to know what the recourse is, and they want to, you know, ideally would at that point like to talk to a real person to make sure that somebody takes it seriously and that it's resolved or escalated through the business. It's not just, you're not just kept in a hateful customer contact center holding pattern. And I think, you know, the AI conversation, and it's really challenging for legacy or incumbent institutions, is that there is this enormous commercial and market pressure to perform, to take out costs, to hollow out the organization and to replace it with technology. But I think, you know, in the longer term, you know, those organizations, those, you know, in the longer term, you know, big financial institutions or financial institutions, incumbent financial institutions, are only really going to succeed if they think about this at a holistic level, both culturally, internally, and also externally in terms of what is the kind of relationship they want to have with their customer and how are they going to extend or grow or add value to that customer relationship.
Thank you, Simon. You made a great point and something that resonates a lot with me personally, which is that oftentimes we get so caught up with, the hype and what we refer to as the bandwagon effect or the FOMO effect. There is the fear of missing out if you're not among the first 5 banks to launch it, and if your customers have done it, there is an implicit pressure on the digital team to go out and also be seen as the cool guys trying to do something, versus the always relevant approach of putting the customer front and center and starting with customer pain points, customer experience and customer journey. So I'm grateful that you reiterated that point. It's important, and it's important to stay anchored in this true north. But I'll go back, Arvind and Avril, if you guys don't mind, to a couple of points that you made, which is not necessarily customer interfacing, but more of the back office issues. One of them at least is. And Arvind, you mentioned about delinquency predictive modeling, which I have also experienced in my career as a banker. But of course, now times are different and unique. And in fact, if I were to go to any conference and present before 2020, the reference point of a crisis always was the 2008 GFC, right? And here we are sitting in the midst of a bigger, call it the Great Recession, Great Depression, whatever. People are still trying to find the right adjectives. But given that AI, at least when it comes to credit modeling and predictive modeling, has really taken off after the 2008-9 crisis. And here is the first real significant test of its robustness. In your experience and in your assessment, do you think those models will pass the test when it comes to, and we are already seeing banks beef up their loan loss reserves big time, right? We've seen the results come out from banks all over the world, and they've ramped it up 4x, 5x, 6x. Do you think these models will hold?
I think it's always a tricky business to look into the crystal ball and try and gaze way out beyond the horizon. But my own sense is that I think the reason why there was a great adoption of ML was that you could actually build adaptive models. And we know, going back from our operational careers, then I go back as far as early 90s when I was running a credit collection shop, and we implemented FICO scores, and there were behavioral scores that we used as well as collection scores. But at the end of the day, they are static largely, and refreshing a scorecard takes 12, 18 months. And therefore, I think in today's environment, anybody who has a dynamic adaptive scorecard using ML is probably in a better place, because it's not about just whether the delinquent customers has the ability or the willingness to pay. You need to now add on environmental factors triggered by COVID, which is, where is the customer to start with? Because a lot of folks may have moved down, maybe working from a different location. Environmental factors like, are they still keeping their jobs? What's their current, cash flow situation, etc. So all that is not readily available as internal data sets. Oftentimes, in the aim to reduce and simplify the customer experience at the front end and reduce the number of fields in the application form, over time, banks may have let go of a lot of valuable information and have been overly dependent on the score. But in current situation, you need all those behavioral data sets, which banks now are scrambling and looking for from external data providers, to actually supplement the models that they have built. So I think it's going to be a case of those who have actually in the last 5 years used AI, ML, created and trained models which are adaptive. I think they should actually be in a better position. Others who are operating with legacy, tools, I think are going to have a pretty large inventory of cases to work through, and they will take a greater share of the pain.
Thank you. I can go on, but let's hear from Avril, and then I'll probably ask another follow-up question.
So for personalized approach, I think banks, they want the safe and low risk approach to financial management. And I think unique experiences are the way forward. And there's one example I like to give, which is a personal example of a traditional bank who I've been banking with for more than 20 years, but unfortunately I don't use it as my regular bank. And so the inflow is usually the same amount every month, and the outflow is usually the same every month. And the arranged overdraft was also arranged many, many years ago. And so unbeknown to me, I was being charged fees for going overdrawn on this particular account. And they didn't contact me once to advise me. And I think, letting customers down and taking fees from things, and where they have all of the data, they've got 20 years of historical data of mine. They could easily have been able to, seen the pattern and the behavior change and notify me of this. And then I would have, received that personalized service, and I would have become a much more loyal customer to them. And hopefully that we'll start to see banks leveraging this customer data. And I think we just mentioned it, that they have never used before, but they have had, they know more about me than perhaps they should. And they have never used it. And so I think, using behavioral data science and really leveraging that data to really understand their customers will really help them to build products and build that loyalty.
Thanks, Avril, and thanks for that example as well. I'm smiling because at least I personally have been hearing about hyper-personalization and this segment of one story for more than 20 years now. When I first entered in my first week at Citibank in my banking career, I heard this. 20 years later, I'm still hearing it. So I don't know how far or how near are we to that. And, and that actually segues neatly into the next set of questions or question, which is basically the challenges, right? So we can say all we want about the power of AI, the power of models and adaptive learning, as Arvind said, but let's look at some real life, pragmatic, practical challenges that we see in banks and also with fintechs when it comes to applying these things. And the first I would ask, and this is where I would love to hear from Greg and Simon, please feel free to jump in as well. Greg, you've run one of the new age banks when, in a very vibrant market like China. Tell us about integration challenges of bringing all these tools and technologies and embedding them with the core system, because I know the incumbent banks have been struggling. And when Arvind was talking about omni-channel, I was reminiscing my own experiences about the endless challenges in trying to combine the contact center data with the web stream data, with the core banking and the core card system data. It's and this is across multiple countries, so it's a nightmare. But tell us, maybe perhaps tell our audience one or two best practices when it comes to applying these and how to circumvent these integration challenges.
Okay, I guess the good news and bad news on good and bad side of it, when you talk about a developing market like China, and I think that if you tackle specifically China, very often when foreign banks come into China, they would bring the so-called the foreign tools coming to China and expect that it's going to run. And but unfortunately, each market is different, especially a large market like China, similar to Japan, I guess. That you would want to look at the locality of it. Say, for example, a simple thing, just even a chatbot, right? We have something developed in the home office, and we try to bring it over to China, but actually, it's a lot of translation. All these things actually not exactly what you cannot just bring a standard type of translation engine and coming in China works, because the way they talk, the lingo and everything is different. You just don't copy it from a textbook. So these are the things that there are local tools available from Baidu, and those are the libraries that you can actually take advantage of. You don't need to reinvent the wheel. You don't need to bring in another foreign engine to come into China. So these are the things that that a lot of global firms need to learn, because they've come a long way in China, that there are tools available, there are systems available, even core banking system, for example. There are, a core banking system, Huawei, for example, a lot of people don't know that they actually develop core banking system on the cloud. And this is something that a lot of people that don't even know. And that's why there are a lot of tool set that you can do to bring in the integration, into China. But I think, if we coming back to, when we execute a project, I think what to me, I think the integration, selling to the, getting the buy-in from a global, the headquarters is one thing, what are the tools available, what are the things that we need to integrate. But I think the most important thing is still the cultural aspect of it, which I find over and over again, every time when you talk about, global banks settling in China, there's always a cultural challenge where the two sides of it. One is the not understanding the local sort of environment, or the let's say the customer experience. If you're building an app, an app, for customer, and a security trading system, for example, the look and feel is entirely different. You have to redo the whole entire thing. You cannot just bring the foreign product into China. And then the other thing is the from a internal standpoint, I think what I find is that very often, if we try and integrate with the so-called the home office, because the data ownership is all siloed, and it's very difficult to put it into one. And the single moment of truth is very often you need to argue in different departments to try to consolidate it. And if you can't solve that data problem, you failed the project already. You fail half of the project already. So I think those are the things that I would say probably have to somehow need to tackle. From cultural aspect, understand the local customer perspective, and the other thing is really the headquarters itself. What are the things that you allow and empower to do, and can you actually realize it? It's not just China; it could be any locations.
Thanks, Greg. And I totally agree with you. And this cultural challenge is not unique to China. When you work in a global bank, every country has its own nuances. Every sub-region has its own nuances. And these are oftentimes significant challenges in any kind of a top-down model, or trying to create a single instance system. But I would actually go one step further and say, when you talk about cultural challenges, it's not just a Western China kind of a story from a national boundary perspective, but also within organizations, different departments, and legacy mindset. So that is another cultural challenge which continues to be almost as severe, if not as severe as it was 5 years ago when I was trying to implement some of these projects. So thanks for articulating that. Simon, I now want to come over to you and address a couple of the other challenges, which are probably a bit more philosophical, but as important, or perhaps more important, from a policymaker and from management perspectives. One of them is tech appetite. I think Greg in the beginning very briefly alluded to high frequency and algo trading. And I have been on panels, and I have seen presentations on, and again, I'm not claiming that these are validated or valid. I am only saying I have seen those claims that algo trades or algo trades run by machines perform significantly better than human traders. Now, my question is, keep aside the veracity of these. Some of them have claimed that they've outperformed S&P, etc., over a consistent period of 3 years or more. But assuming that we are getting there and the models are getting more and more refined, there's so much data to learn from when it comes to market data. Are we already seeing the space shrink for the little guy? And again, it's a philosophical question, but in these wars of machines, is the ordinary investor, is the ordinary customer, is the little guy getting squeezed? Are we seeing tech appetite in this new era?
Well, I think, yes, thanks for that. I think firstly, I'd come back on what Avril said, which is, this whole, and what you referred to, banks have been talking forever about the single customer view, and they still don't have it. Now, and I think even when you talk, we've surveyed fintech companies over several years, all through the beginnings of the fintech revolution, what could arguably be called the fintech revolution anyway, in the last decade. And I think, companies themselves and the marketplace in general is quite often wildly over-optimistic as to exactly where data sits in terms of the progress that's been made. Actually, fintech firms themselves aren't that confident, for various reasons, of their ability to use the data that they have, in the way that we're certainly not in quite the way that we're talking about now. And if you look at the market, I think really it's only the big five, the big five US tech firms that are sort of proving that the value that data can create. And I think everybody else, the other 495 companies in the S&P 500, are still trying to understand, quite what it is that they've managed to achieve. But to come to your point specifically about the philosophical questions here, I think for me, the key word that you mentioned is better. Somebody wrote, an academic wrote in a paper published by BBVA last year, I think it was, saying intelligence is about the ability to do something better than the alternative. And the problem we're all going to be sitting in, and I think COVID and the impact, the sort of the ongoing impact and the impact afterwards is going to bring this, really sort of front and center, is how do we define better, and who should be who is it that's going to define what better is and what better looks like? So, if we look at open banking, for example, which is sort of gradually iterating around the world, open banking has been, was introduced in Britain, obviously, a couple of years ago. It was done, it was led by the regulator, and other parts of the world are using, there's a juncture, isn't there? There's a question between, do we go the regulator-led route or do we go the market-led route? And at the level of open banking, that's probably satisfactory. But when we look at something as big as COVID, which has truly taught us, the importance of data that we can believe in, that we can trust, I'm not sure that kind of question mark can be left open. I think ultimately what we will have to have somehow, somewhere, or in whatever shape or form, at the level of the UN or independent bodies or whatever it might be, there will have to be some kind of agreement as to what constitutes an AI that can be trusted, because that's at the heart of all of this. It's at the heart of us wanting to give our data. It's at the heart of us wanting to transact, whether that's financially or just simply a data-only, non-financial transaction. So, when I look at the map that we're kind of building out, there are core banking, automation, AI-related or adjacent companies springing up in all parts of the world. I was looking at the map this morning. There's a company in Rwanda which is helping digital banks and local incumbents digitize their operations. They may have, they may not, but they may have something which is enabling inclusion in a way which is much better than something that's being tried in Western Europe or in the US or in Southeast Asia. But I think in a world where we're moving to this kind of ecosystem approach, where therefore data is going to be shared more and more, unless we come sort of back to first principles and say, well, actually, this is the kind of data that we have to have, and it has to be replicated across these segments, or it has to include all of these fields. I think we're going to run into, down the line, quite substantial potential for systemic risk. And in fact, there was a World Economic Forum report issued at the beginning of the year, so just before the kind of full global lockdown, where I think 50% of the banks and FinTech surveyed were saying that, and again, ironically, they don't think this at the level of their own institution, but they do think that regionally, globally, 50% of them reckon that we are storing up potential for quite massive systemic risk. And I think, unless there's some sort of alignment as to what constitutes AI or good AI, we won't be able to decide what is better or what is worse.
Thanks, Simon. You've touched upon a very important and hot button issue, which is data sovereignty, data privacy, data rights, and that's a discussion, whole other discussion for some other time, but extremely timely. And we saw the big 5 CEOs at the congressional hearing, what was it, earlier this week? And one of the key themes was about the enormous amount of data they sit on and how they are using it. And I like how you kept harping upon this thing of better. And again, to kind of close this thing from a philosophical perspective, I'm reminded of one of the very important influential books that I read very early on in my college, and the first Stephen Covey's 7 Habits, and he talks about doing things right versus doing the right thing. And I think that was the core of the debate we are having here, as well as the congressional hearing. are what is better, and are we doing the right things and not just doing things right? We have a couple of audience questions, so let's try and address those as well. We have precisely 5 minutes. So the first, this is open for anybody who may want to take it. We touched upon alternative credit scoring using AI. Are there any examples, and if I may say, are there any robust examples that any of you would like to touch upon or you've encountered?
I can take a stab at it. I think the credit scoring, I guess, is a fairly broad term. And if we look back at the last generation, kind of applications that broke out into various parts of the credit cycle management process. So you had your application scores for onboarding, you had behavioral scores for managing a customer, during his credit consumption. And then you had the collection score for managing delinquent inventory. So I guess there's been different extent of application of AI ML in these three areas. I did speak about the collections one, and that actually splits out into two use cases. One is, of course, prediction of early delinquency. And the one that I was personally involved with, it was AI ML startup that worked successfully with a big three local bank in Singapore, and was also kind of there was some involvement of the local regulator. And in that case, we did see some pretty good results. We saw some 85 basis point reduction in roll rates of early buckets, and a 6-month payback. And that was then subsequently applied across 9 markets for that particular bank. And sorry, it wasn't a big three local bank, it was a global tier 1 bank who then took it to 9 markets. So that's on the collection side. On the portfolio side, the same ML technologies can be used for looking at charge-offs. Essentially, what is going to be the level of charge-offs? Earlier you used portfolio level heuristics to actually estimate your charge-offs, and therefore what provisions you have to make. You can actually get it down to the level of every single account, and what is the propensity for charge-off emerging from a single account, which is sounds like a bit of a holy grail, but I think that there are charge-off models that are available. I know of these two. I'm sure there are ones in the application scoring side as well, but I'll stop there and hand it back to you.
Thanks, Arvind. So this is hyper-personalization when it comes to not just customer interaction, but delinquency modeling as well. Interesting.
Yep.
Anyone else would like to add to that?
There's one company you might want to look at. It's a US / Israeli company, actually, technology developed in Israel, called Pagaya, that recently went through quite a large funding round. They're not credit scoring specifically, but they're enabling better lending decisioning for sort of small and mid-sized banks in the US, and doing that at a multiple better than. Again, define better, but enabling lending to kind of customers that perhaps would have been excluded previously, and they're also looking at sort of how that model might be expanded into subprime, again through sort of better automated decision making. But have a look at them, pagaya.com, I think it is.
Thank you, appreciate it. So we have one more question, and I think this is it. We don't have time for more, which is from Anthony. Basically, any examples of AI when it comes to RegTech, then perhaps you can address that. Ushi, do we have time to take this question, or we have to?
Yes, you do. Yes, you do. You can go for one more. Go ahead.
Anyone would like to address the specific question on RegTech, AI in RegTech?
Yeah, I can speak to my experience again working with another startup that is Singapore-based. They are in RegTech. They're called Tukitaki. And they have built actually a solution which is for suspicious transaction monitoring. And what that does is to essentially, train so what they use is like a stacked ensemble model, which actually, is a variety of algorithmic approaches. And then there's a champion challenger within that. And what they've done is to be able to train the model on historical data so that they're able to identify with a probabilistic score as to whether a particular alert that is generated by a rule-based system like Detica or Mantis, etc., is in fact a suspicious alert or not. And that allows categorization of alerts into high, medium, low, and so that you can have the compliance analyst focus on the high risk alerts, and you may choose even to let the low level alerts pass through, and then continuously there's an adaptive learning model, so you can fine tune the outcomes and the level of risk that you're willing to take. This is the use case which is applied in a local big three bank in Singapore with some kind of overseeing by the local regulators.
Thank you very much. Fajar, unfortunately, we won't be able to address your question. We are at the end of our conversation, but do feel free to reach out to us and we'd be happy to discuss it offline. With that, ladies and gentlemen, we come to the end of our panel discussion. Unfortunately, time has run out. I had a couple of other important questions that I wanted to, or themes that I wanted to cover, but hopefully some other time. And to Arvind, Avril, Simon, and Greg, my sincere thanks for sharing so freely and so insightfully. Mushir and Shikha, thank you for giving us this opportunity, and all the best, and keep shining. Thank you.